Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our October monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we've got a lot of ground to cover. I want to thank those that attended our quarterly investment forum this week. We had a great group of over 100 that attended. Enjoyed some market analysis for the guest speaker from Fidelity and also food and fellowship at Perry's. We look forward to seeing many of you at our curbside event that's coming up on the 9th. You should have already received an invitation. We hope to see many of you there. We have a great new team member to announce. Stan and Stephanie welcomed Mark Henry Robare last week. So their baby boy is doing well. Mom is doing well. They have 2 daughters and now a son. So we want to introduce Mark Henry Robare to our valued clients. So markets are volatile at present after a rough September. We've seen the market down as low as 8%. It's still up so far year to date, but September was a weak month and October continues to show some signs of weakness. One of the interesting things about the market so far this year is market breadth or lack thereof. What this shows is the equal weight index versus a cap weighted index. For those that don't know, a cap weighted means that the largest companies in the S&P 500 are really the primary drivers of return, versus equal weight takes all 500 companies as an example and applies an equal weight to them. Well, what you see is that for the largest width since 1998, you've got cap weight outperforming equal weight. And so kind of what that shows is the returns are really concentrated in the mega cap and even more narrowly mega cap tech sector. We all know that 98 was followed by a great 99 and then a dot-com bubble that burst. So that concentration of sector-based performance is something to keep an eye out on. Not saying this circumstance will end like 99 did, but it's certainly worth keeping an eye on. So historically, September is a bad month, and it was this past September, so down just about 5%. We continue to see some weakness in the markets, a lot of that driven by geopolitical factors with the Israel-Hamas war that began in early October. So following that, now we have 2 kind of major political conflicts that are affecting kind of geopolitical concerns, oil prices, possible recession, and all of those kind of things. So the market's continuing to be a little bit weaker in October from where we were in September. However, the last 3 months of the year are typically good months. So this is going back to 1926. October, November, and December on average are up months. Whether that will be the case this year or not remains to be seen. As it relates to inflation, one of the major things that the market's responding to, 3.7 is the most recent CPI read, with core that excludes food and energy at 4.1. On the one hand, inflation is a lot lower than it was in June of last year, where inflation spiked at 9%. But on the other hand, we're a lot lower than the Fed's target of 2%. If we do call June of 22 peak, that's pretty supportive of stock and bond prices going forward if we don't reset this peak. Again, 3.7 is our most recent read of CPI. Again, a lot lower than 9, but a lot higher than the Fed's 2% target. We've got the Fed raising rates the highest level in 22 years. Most people believe there's at least one more hike left, and then a prolonged pause period of time. How long is we await to see. If we look at returns after the last rate hike, so if we think the Fed's going to raise in November, what do stocks and bonds do going back to 94 after the Fed hikes for the last time? And they're pretty supportive on a 12-month basis. If we look at stocks and bonds after the last Fed rate hike, which most believe will at least include one more in November. And if we look at the average length of time between the last hike and the first cut, on average, that's about 10 and a half months. So if we call that November, that would look based on average into the October, November of last year, although the Fed has indicated higher for longer is likely. So that could mean that this average of 10 and a half months, that it's longer than that this time. So the economy remains not in recession mode, not growing great, but still expanding. 2% is the most recent read on the economy. Over 2/3 of that is the consumer. So how the consumer is faring is worth looking at. We've talked about this before, but debt service ratio is picking up, and delinquency rates in auto and credit cards are picking up as well. So part of the result of higher debt service cost means that more and more of this is delinquent. So there's some cracks being indicated with the consumer. One of those cracks is as it relates to home affordability. As rates have gone up, you've seen existing home sales go way down. This makes a lot of sense. Why sell your 3% mortgage to get a 7% mortgage? But if we look at overall housing affordability, which is another consumer crack, with rates where they are, housing affordability is at its lowest point since 1989. So again, the consumer that drives the economy, some signs of weakness that are worth following. Jobs remain strong. The most recent jobs report over 300,000, 3.8% is the unemployment rate. Average hourly pay over a 12-month basis up over 4. There's still an imbalance as it relates to job openings, still 1.5 jobs roughly for every unemployed worker. Before recession, it was at about 1.2. So there's still ample jobs available, and so the demand for labor still exceeds the supply. The last thing we'll talk about is earnings. We're very early into Q4 earnings, but if we look at the 78 S&P 500 companies that have reported, which is about 16% of the index's total, we're seeing overall up 1.6 from the same period last year, 5.7 higher on revenues, 81% beating EPS estimates, and 63% beating revenue estimates. So again, we're very early in the earnings season, but overall, pretty good overall report on earnings so far. So again, one of the things we would encourage you to do is to contact us about anything that we've talked about here, anything that's going on with you, to talk about how all of these things apply to you personally. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. Please reach out. We're here to serve you. Until we see you again, be well and take care.